Hello, Baker Financial Institution students. So I hope everyone had a great week and is having a good weekend. So we are now approaching week 3. So I want to give you an overview of things we have going on this week. We're going to be reading chapters 7 and 8. You're going to read about kind of the idea of moral hazard in markets and principal agent theory in chapter 7 quite a bit. And then you're going to look at financial crisis in chapter 8. And I've included a documentary by PBS Frontline. It's one of my favorite documentaries about the meltdown from the subprime crisis, and it ties in so well to what you're reading in Chapter 8 to give you additional insights. So when you get an opportunity, definitely encourage you to view it or to at least skim through it. So it's a relevant piece of history and how we made changes since that time period, and whether question of whether we were sticking to what we said we were going to do. So we'll talk more about that in a little bit in the video lecture. But first, just a reminder, do your reading 7 and 8, forum discussion post, continue with that. You're doing a great job. And then obviously the quiz, and start thinking about which bank you'd like to research. I think next week I'll post out there a forum just to people that can post which bank they want to do the research on. Next week we get a little bit of a break. Will be nice. I'll still have a video mini lecture, but we don't have a forum discussion, so consider it spring break. But hopefully you can have some of that time to think about your final project. So with chapter 7, it asked, why do financial institutions exist? Our economy really depends on a solid financial system. Without that, we would not have the productivity level of GDP to get money from savers to borrowers, and borrowers that have productive opportunities for investment to help grow the economy. It was interesting, the text that talked about how the U.S. differs quite well. It differs from other nations in the sense of the use of financial intermediaries. We only use 18% about for loans through banks. For other nations such as Germany, Japan, they can go as high as 76-78%. So although that we do issue some in bonds, about 32%. It's not as glamorous. We hear all the time about stock markets, but stock market only represents about 11%. Even though it gets the headlines in the news, and Friday the stock market did well. It came back a little bit, so it's kind of interesting to see what's going to happen with the stimulus package and concerns of inflation in the future. You guys have been posting in your forum post about the increases in the 10-year Treasury yields, but these financial intermediaries can be like insurance companies, pension funds that loan directly to different corporations or to different parties. So, but again, it's important to have regulation in these markets. It's a balance of that regulation, and that's what you'll hear about in the video if you watch Inside the Meltdown. So, obviously, one of the benefits of financial intermediaries is a way to reduce transaction costs. The textbook talks about economies of scale. What you think back to that is the lowering of average total cost. And this is something that I've seen going on in the banking industry for many years now. You see a lot more consolidation, especially after 1997, and they allowed the crossover of state lines. And I see this in general for a lot of firms in the United States. Although we promote competition, I think it's just going to continue. We're going to see more and more oligopolies, in the sense that in order to compete, they're going to have to take advantage of those economies of scale. So other things too, kind of the nice thing today with the advancements in technology and expertise, I can go into my Fidelity account and I can look at all kinds of information, and it's as you have mentioned some of your posts, it's so easy to get into the equities market, such a low cost and transaction cost. Where when I graduated from college in the early 90s, I thought I wanted to be a stockbroker, and every guy would go to a stockbroker and you'd pay commissions and everything. Well, a lot of that can be done by individuals today. So the cost of doing things, and in that market too, it's been consolidated. I'd say there's probably like 3 big players: Charles Schwab, Fidelity, and there's one more. Control about 60% of that market. So, but it's much easier to get into at least the equities markets today. So, I want to explain a little bit of adverse selection and moral hazard. Adverse selection is one party knows more information than the other. So, someone wanting to borrow money knows about their opportunities to pay back this money, how well their business is doing. The other party, the bank lending them money, may not know all that information. Common Times and these types of books, they use the lemon problem about like a used car salesman and knowing information about the car, and you're trying to gather as much information about that car, reading about the car, the reliability or the mileage and the service record, and as much as information you can obtain to try to make your decision. But obviously the one selling the car or the used car dealer knows more information than you. So moral hazard relates to whether those that we put in charge of the financial system, and there's other situations too, but basically, that you're how much you take on risk. Like if you have health insurance, you may need to go skydiving, skiing, and other things that can be hazardous to your health, but because you're covered, you may take on more risk, and that's kind of the question. Under financial institutions, how much risk, or how much, let's say, like the corporations, that they have the money or they borrow the money, what type of risk they take on. So that there's certain tools that financial institutions or financial intermediaries put in place to try to eliminate that risk. And the textbook kind of goes on an example. They talk about the free rider problem. One example they related to is that if you have someone that does have good information about a stock, then what would happen is like, oh, if this person knows good information, then I will buy that stock too, and I don't have to do as much research. It results in the free rider problem. Then it would be harder to find eventually securities that were underpriced. But ways specifically that we try to eliminate the moral hazard problem and adverse selection is government regulation, the SEC requiring independent audits. And you go through a case study in Enron, how we do not understand their accounting books, and it brought a lot of changes in the Sarbanes-Oxley Act and accountability for CFOs to accurately report information, so information was shared accurately, so people could understand the value of the companies and their earnings potentials. But again, that if you're a well-established firm, you're more likely to go to the equities markets as opposed to going through a bank, because it's easier for you to attract capital. But again, you'd have to be well established and have good credit. They also talk about the principal agent problem in this chapter. Essentially, I want you to think of the principal as the owners, like the owners of a debt, the owners of a stock or a company, and the agents are the managers that we hire to manage these companies. And you try to put things in place to provide incentives to them to make the companies profitable or do the right things. But there are other things that the textbook mentions. Could be government penalties. Venture capital is a good example, that I will give you a little bit of money. If you start doing well, I will give you more money. And then, there are debt contracts. And I would say for some firms, those are publicly traded companies, I would argue sometimes debt can actually be beneficial and eliminate some of the principal agent problem or moral hazard problem, because if it's just equity, that there's no accountability recourse, but if there's debt, well, I got to make sure the company is doing well and doing efficient and profitable in order to make sure that I pay that debt. So some other things, with addressing these moral hazard, they mentioned about net worth and collateral, bond covenants, keeping collateralized valuable. Like if you buy a new car and you have to take out a bank loan, you're going to have comprehensive insurance on your car, so that way if something happens to it, it's covered. So that it's the idea of trying to keep the collateral valuable and keep that information available. So. The last part I just kind of want to discuss is about the financial crisis, and the document I put out there. Like I said, I really enjoy the document. I'd highly encourage you to watch that, because it's very informative. Explains a lot of how that led up to that time period and how it changed some of the things that we do today and increased regulation. But some believe, like during the Trump administration, we kind of got away from some of that. So, is there potential for another crisis? I will tell you that crises always happen. I remember in my lifetime where the savings and loan crisis, when I worked for Midland Loan Services, basically what we did is we reserviced all the loans for the Resolution Trust Corporation. The government had to buy up all these loans from like shopping malls in these different places like Virginia, North Carolina, California, that went bust, where you had bank managers lending out loans that were probably not the best decisions, and anticipation that these shopping malls and everything else was going to continue to do well forever, and it didn't. With the dot-com bubble, we had that, and then the Enron crisis, and then the most recent, the subprime crisis. And I'll just discuss a little bit about the textbook talks about the different stages. They talk about the credit boom and bust. The subprime crisis was this boom in housing and a boom in running these new financial derivatives called credit default swaps that were making a lot of money for these Wall Street firms, anticipating that the mortgage market would never fail, or Lehman Brothers would never fail. So they were writing these basically without having any collateral to back it. It would be like an insurance company writing all these policies and car loans and never having enough to pay off if there was a major disaster that would occur. So we would say, that was an error on not regulating that market. But then they talked about the debt deflation. And I remember working for a firm, U.S. Central Credit Union, that had a lot of these collateralized debt obligations. They're kind of packaged together loans as collateral, but as the collateral went down in value because of the devaluation, the government had to step in and put them in conservatorship, because they're basically saying, based on your books, you don't have the value anymore to be a stable financial institution. So, but crises cause disruption to the system, and that's what we want to try to avoid. The textbook is interesting and talk about the Fed and Ben Bernanke in that time, and were they to blame for some of the increase in what we consider an asset bubble in the housing markets. One thing interesting recently is the housing price has gone up quite a bit, probably because of low interest rates. We'll be interested to see if this kind of tails off a little bit now that long-term rates are starting to go up. So that may help keep that in check. But at that time, Ben Bernanke was arguing was kind of the many mortgage companies were making questionable loans in the terms of profit. These interest-only loans, or lending out to people that really couldn't afford the loans if something happened, and people were leveraging themselves to buy additional houses to try to make money in the housing market. So it kind of a series of different combination of things really allowed it to implode. But that's it for this week. So look forward to your phone post this week. Again, I'll do the same thing. I'm kind of rotating. I'll jump in the last third of getting responses to those individuals I haven't responded to yet. But again, if you do have any questions, do email me, and I'm happy to meet via Zoom if you need to do that too. So take care and have a great week.